Okay, we're going to start today by looking at the S&P like we usually do at the beginning. We had a situation this week where we had the Federal Reserve increase the interest rates by um, 50 basis points. So we knew that that was coming Wednesday. We had a lot of interest, a lot of buying up to that time. So our golden rule is if there's a major event in the stock market and the there's a lot of buying before that, um, there's a good chance it would sell off afterwards. So we had buy on the rumor, sell on the news, and what's happening, and we had that in a couple different ways. We had bond equivalents, high yielding um, securities. They were anticipating a rate cut. And as soon as that happened, then they sold off. So that's over with. What's great about um, having this event behind us, the Federal Reserve meeting, is it allows there to be more certainty in the stock market. And the stock market usually likes certainty. Um, so, and the one unknown right now is whenever there's a um, election in November, we don't know how Congress is going to be divided, and that might determine new legislation based on who's in power or who's not in power. That's the last unknown. And of course, who's going to win the presidency. So, with that behind us, we have an oversold market. So, if we look at our stochastics, we have a well-defined trend line, and we're right near the top of the trend line, and we're overbought. So, and we're in one of the worst months of the year. So there's a good chance we're going to be going down next. Okay, so what else do we have to look forward to at the end of the quarter? This is September. End of the quarter, there's end of quarter window dressing. So every stock that did good this quarter or up to this year, there's going to be a lot of um, hedge fund managers and mutual fund managers trying to get that stock in their top 10 so they look good. So that's called window dressing. Um, and October is, we've had a lot of big crashes in October in the past. We've had 1987, we've had 2000, a lot of different times, but in general, October has been a good month. So if we look at our average market returns, October turns out to be one of the best. And of course, November and December are seasonality wise some of the best months of the year too. So we don't have earnings coming out until January. So there's a lot of um, time right now. All we have is government reports. Now that all the earnings reports have came out, basically. All right. So what are we? Our points here. Um, okay. So we had the Fed reducing interest rates by 50 basis points, but the treasuries are up 2.5%. Why would that be? Um, usually, you see, well, usually what happens is there's an inverse correlation in the stock market versus the treasuries. So let's look at that chart because it's very important. Okay. So this is the 10-year treasury. It's down today. And let's look at the S&P. So our formula has been for a while now, as the interest rates yield goes down for the US Treasury 10-year, the stock market has gone up. And that correlation is kind of staying consistent. The theme is if the rates go down, then companies can borrow easier with for a less amount of money, and they can finance growth activities better. What else do we have to say here? We have market breadth is improving. We have a lot of bullishness in the stock market. This is 81% of the S&P is up above its 50-day moving average. 78% is above the 200-day moving average. That's a sign of bullishness, and that's a sign that the stock market is um, very excited right now. And our theme from the beginning of the year, revert to the mean. It's working pretty good. Healthcare, telecom, financials, utilities are all doing very good this year. Energy is the worst performing. And let me see. Let's look at some more other notes here. Okay, the price of oil remains low. That's an indication the global economy is slowing down. So we know the American economy is slowing down. The trick for the Federal Reserve is trying to make the environment good enough where we don't have a recession and we're still growing. And let me see. Inflation is pretty low. It's at 2.5%. The dollar is continuing to slide and go down. And what else do we have here? Gold is there's a bid for gold these days. So gold is going up, and it's one of the better performing consistent assets right now. And we can see the dollar is going down. And okay, it says because gold is dollar denominated, a stronger dollar tends to drive gold prices lower. But as the price of gold goes down, as the dollar goes down, that helps the price of that helps the price of gold go up. So that makes sense. Maybe it is a very good correlation between dollar index and the gold price. All right. So hold on for a second. Okay, so fear greed index, we are greedy right now. That kind of matches the stochastics being overbought. Whenever we're in an overbought situation and there's greed in the market, you have to take some profits off the table or don't buy. This is not a good time to start buying new positions. And we have much more bullishness than bearishness in the AAII survey. Okay, so it's the same indication. You'd like to do things contrary as an investor. Okay, so the VIX is behaving. It is at 17 right now. It was 17 last week. So we don't have a whole lot of fear in the market. And right now we're at a greed level in our emotional map. So I put a couple new things that may lead to a crash. If the Democrats or Republicans win a majority of the Senate and the House in the upcoming election, there might be uncertainty because there could be a lot of laws passed that will change how companies operate and the profitability of companies. The great thing about our current environment is we have a decent balance where no laws are passed, not many laws are passed. So in that kind of situation, it has no effect on the stocks basically. And okay, if the U.S. economy slows down to a point where we go to a recession, then the stock market goes down 15% or so. For me, I'm a long-term investor. I don't buy or sell based on if there's a recession or not. It's just maybe a year or so, maybe half a year, the stock market goes down, and then basically the Fed will rescue the market after 6 months or so, and then it goes back up in a year it'll be back to normal. So you just have to live through these recessions if you're an investor. Let me see what else. All right. So let's look at our first to worst. You can see that our worst from last year, we had utilities, consumer staples, energy, and healthcare. Um, they're outperforming this year, everyone except for energy. The difficult thing about energy is you're at the total mercy of the price of your commodity, underlying commodity. And so we have the price of oil stubbornly down recently. So that's why the energy prices are down. Um, but consumer staples are up 16%, utilities up 22%, healthcare up 14%, and financials up 21%. So those have done very good. We also have communication services and IT doing good like they did last year. Um, I'd say 75% of my money is in IT and communication services, only because I'm like a growth investor and I've been buying and holding. And those are the stocks that grow the most consistently and grow the fastest. Okay, so we're continuing our theme this year of AI revolution and weight loss drugs. We have Eli Lilly up a lot, 60% this year, and Novo Nordisk. They're leading the way in the weight loss drugs revolution. And we do have the AI revolution continuing to do good this year. There's build out of data centers, demand for electricity, and the utilities are getting a bid because of the need for electricity for AI. And cybersecurity is securing all of that data infrastructure. Right. So let's look at some of the market movers. Okay, market movers. We have Constellation, Vistra. Okay, um, these are energy plays. These could be AI data center situations. We have CrowdStrike going up 5%. So that our theme of okay, our theme of build out of the AI, the data centers, are in the top couple here. Demand for electricity, cybersecurity, securing the grid. You can see that in our top 10. Yeah, basically every one of these is one of those. So you have Exelon, you have Ameren, energy plays, PPLs and energy, PG&E. Okay, so you have half of these top 10 or energy plays. You have Vistra, they help build the infrastructure for these data centers. And you have CrowdStrike, they're securing the grid with cybersecurity. All right, so that's what's happening today. And Supermicro, um, they build the servers for the data centers. Let's look at the top decliners. Top decliners, FedEx, they had an earnings report last night. They said they had a cautious outlook, which means that the economy, we get basically now until the next earnings reports, we're getting tea leaves suggesting whether the economy is going to be doing good or not. So if the economy is doing good, stocks go up. If the economy is in a recession, stocks go down. And every day there is a new hint of if the economy is doing good or bad, and if we're going to go into recession. And FedEx basically said that they're cautious in their outlook. They're a big they handle about half of the package delivery in America. So they're a good gauge to how the economy is doing. And if they're struggling, there's a good chance that the economy is could go into recession. All right, so and according we have what's the theme here in our top? Okay, we have Old Dominion Freight Line. They're actually a transport, just like FedEx. They transport goods for companies. Um, I'm not sure why on semiconductor isn't. Lennar, they had an earnings report. They disappointed. Um, let's see what. Okay, I can't add any value to any of these. Why these are down. Okay, let's look at the Nasdaq top stocks. Oh, look at that, Airbnb. We're going to go over Airbnb today, because that turned up in one of our screens as a stock that could be undervalued. And we have cybersecurity, Fortinet. They do cybersecurity. We have Excel Energy. Of course, they're an energy company. Exxon is an energy company. All right. Okay, so that's what we got from that. Okay, so let's look at the sectors. Before we look at the sectors, the treasuries, the 10-year treasury yield is going down today. So if we look at our sectors, we expect stocks that are affected by interest rates to be doing good. So utilities, as the yields go down in the 10-year, the demand for utilities goes up, number one, and also you have this AI need for utilities, the power from the utilities. So that combination is making this sector go up. And investors want a yield in their investments as the interest rates for the 10-year go down. We want a high yielding investments going forward because in a year it's going to be really hard to get a 4% dividend. All right, so we have gold miners going up today. That's because the price of gold is going up as the dollar goes down. So if we're predicting the dollar to continue to go down and to be weak, we'd expect the gold miners to be um, a good sector to buy. Consumer staples, and okay, these are very conservative stocks that are in their sectors that are going up today. Let's look at the ones going down the most. The semiconductor ETF. Okay, so yesterday we had a pretty big rally in the semiconductors. So they went up 3% yesterday. A lot of times whenever you're in around, let's look at okay, when you're around a Fed meeting and there's a major move, there's market participants basically don't really know a whole lot what to do. They're kind of confused and they're selling a lot. Whenever it was announced, the market sold off. And then yesterday we had the stocks going up a lot. And now, we have the possibility of the stocks going down again. So this event basically mapped out the interest rate of what's going to happen for the rest of the year. So we're going to basically have another interest rate cut in December and probably another one in the next meeting after that. So it's going to be really hard to get a good yield for your investments going forward. So people are going to be gravitating towards high yielding investments and boring investments like healthcare and banks and utilities. So that's going to be a theme pretty much until the next earnings report. All right, so let's look at what else is happening here. Okay, so I'm looking right here. We have a overbought situation in a majority of our indexes. So this is the QQQ. You can see it's overbought at 90. You can see this one is the defense sector ETF. It's overbought. This one's overbought. This is gold. It's overbought. And XLY is overbought. So you have a situation where the stock market basically rallied into this rate cut. And there's a saying, buying a rumor, selling the news. So um, my guess is we're at a top right now in the stock market and we're going to go down for a little bit. And we have uncertainty with the politics, who's going to be the next president. Okay, so you can see that we're basically atop and overbought in a lot of different sectors. So, okay, so there's a good chance we're going to be correcting a little bit here for the near term. All right, let's look at some more talking points for our meeting. Okay, let's look at Dan Now's picks from the beginning of the year. Amazon up 25%, Meta up 58%, and Texas Instruments up 20%, and XBI up 15%, and KWeb has gone nowhere. It's 0%. All right, so looks like Meta is the best performing stock of his picks this year. So they still have the election coming up. So in the next month or two, they're going to get a tailwind from the election advertising. So both sides are super close, and you know that there's going to be some ads shown. So we'll see. We'll think. So that means the next report for Meta is going to be pretty good. Okay. So I picked out a few interesting charts. This is the XLU. This is the utility ETF. We're pretty much overextended and we're near the tops of our channel. So the interesting thing about the XLU is they were actually in the top 10 today also. So this has been the worst performer last year sector, and now it's one of the better ones. And um, so we're going to have to, this is the first time we went through a complete rate cycle together. So next time we do a rate cycle, we'll have to predict the sectors doing good and bad. Right now we're starting a rate reduction. We're going to go over a couple of different sectors that'll do good when the rates are going down. But this one, yeah, continues to be overbought and in high demand. Let's look at the next little, we have Altria. You can see that this is one of the only stocks we're following that is oversold. So what happened was there was an indication that the interest rates would be going down, right, starting about right here. And as soon as we knew that we were done raising rates, and we knew that the rates would be coming down, that is buying the news, buying the rumor. And then as soon as that happens, there's a sell on the news. And so a lot of the major high dividend stocks and related securities went down after the interest rates were announced. So, but we have a situation right now where we have a stock that's oversold and starting to go back up a little bit and at the bottom of its range. This doesn't happen very often, maybe once a month or something like that for almost every stock. You can see that, whenever that happens, that combination where you have a oversold condition and it hits the bottom of this channel, that's a good indication that, the stock is going to bounce and go up. So we haven't had this Altria down at this oversold level for a while. So this is what I usually wait for, when I'm trying to buy a new position. So we know that interest rates are on a downward, are going downward, and we know that stocks that are yielding 8% are going to be hard to come by in a year. So this is an example of a stock that will yield around 8%. So let's look at the rule of 72. 72 divided by 8. Okay, so if you hold this stock for 9 years, it will double your money. That's the rule of 72. You divide 72 by the yield of the stock, and that's the number of years that it'll take for you to double your money. All right, so let's look at the next one, JP Morgan. You can see that the same situation as Phil or as Altria. There was um, everyone knew the rates were going to be going down, and as soon as the rates went down, the stock went down with it. Um, that's called buying a rumor and selling a news, and we're actually oversold with JP Morgan now. And a lot of the banks will have better profits because there's net interest margin that improves as you have a yield curve in inversion situation stopping. And so right now that spread is better for the banks as the interest rates go down. So I've owned this stock since the pandemic, and for me it's just it's a number one bank in the world, JP Morgan, and they have a dividend of like 3%. So this is like a example of a stock that's they had a run up, it's like up 30% this year, but it is oversold and it's near the bottom of its range. And another one, waste management. This is a very pricey stock. There's only two waste management companies in America, Republic Services and Waste Management. This is an example of another dividend paying stock. They're oversold and they're at the bottom of their channel. And Boeing, let's look at this stock. You can see it's been in a downward trend for over a year and a half. They can't get their quality good enough. There's always a headline news every couple months or of a new problem with their planes. And on top of that, they have a strike now. So this is an example of a stock. It's like one of the worst charts in the stock market right now. It's going down. And they do have a duopoly. There's two companies making commercial aircrafts in the world. But even with that, they still can't produce enough airplanes. They have a big backlog of orders, but they can't produce enough without defects. So this is an example of a stock that I try to avoid. Quality control, consistency is not there. Okay, NVIDIA. You can see that NVIDIA is still in an uptrend. You can see that it went down October 5th with that crash we had, the mini crash. But you see we're still have support around this 150-day moving average. See this green line right here is the 150-day moving average. And it looks like until the earnings reports come out again, we're going to be bouncing up and down against that 150 moving average on the downside until we have more clarity of how much they're going to be making. So don't be surprised if it keeps coming down to this bottom part of the channel or the 150 moving average. All right, so and Eli Lilly, you can see it's oversold right now. It is at its 50-day moving average, so it still has a lot of momentum. And they're ramping up. The Eli Lilly right now is ramping up a lot of their manufacturing so that it can supply some more weight loss drugs to the market. And it looks like that weight loss drug they have is a miracle drug. It is not only curing diabetes and it is helping weight loss and they come up with new indicators every day that's going to help heart problems too. So okay, so you have this situation where they're overvalued right now. They're like 1.7 times what they should be trading at, but they have a lot of momentum and they have a huge market that they can't make enough of for their market. So that's interesting. All right, so here's some news stories. Apple stock rises on reassuring iPhone 16 sales. Comments from T-Mobile. All right, so T-Mobile had a talk with Jim Cramer the other day, and they basically said that they see strong demand in iPhones, better than last year. So that kind of is an indication that iPhone um, super cycle might be coming. And one bad thing about Apple releasing their phones now, the batch of AI features that people would buy the phone for won't be available until October. But everyone knows that the biggest season for Apple and for iPhone sales is Christmas. So as long as they get their AI features out before Christmas, um, Apple should be okay. But you can't buy and sell a stock like Apple based on demand, the near-term demand for their um, iPhones, because there's always going to be a demand for their product because they have a 2 billion user installed user base. So, but we're still monitoring their growth rate. They're growing around 10% a year now. So, so as long as it, for me, it's paying a 1% dividend or less, and it's growing at 10% a year. So that's a 11% total return. That's pretty good for a really big company. All right, so okay, there was it's an article here, Steve Eisman on the election, Fed rate cut, and big tech. He was um he was a guy that was involved in the Big Short um in 2008. So he's a really good person that understands a bubble, financial crisis, and the housing sector. And so he has his own company, his own home office company. He calls it Newberger Berman. And he basically, in his talk with Jim Cramer for the CNBC, he said there are two dominant themes in his top holdings. One is AI/tech, and the other is infrastructure. So our theme from the beginning of the year for this year was, the AI. It's a couple of the themes were the infrastructure for the AI build out and AI tech, AI related companies. So you can see that, he owns, these are the top holdings in his account. And what I did was I highlighted the stocks that he bought more of. Yep, this is a positive 12%, for instance, increase in a position. And I'm going to go over, maybe why he bought some of these positions. Um, okay, so we know about Microsoft and Apple and Nvidia. Um, so you can see that he reduced a little bit of his Nvidia. It's gone up, what, 120% this year. And he bought 5% more Apple, maybe because Apple has been uh, out of favor this year, at the beginning of this year. He bought more Eli Lilly, and we've been talking about Eli Lilly for a while now. And this NEE is in NextEra Energy. They're an energy company related perhaps to the AI theme. Meta, he bought 10% more of that stock. And Home Depot. So as interest rates go down, people are going to be wanting to fix their houses up to sell them to move into a bigger, smaller house. People have been basically locked into their mortgage because who's going to want to leave a 3% mortgage when you get a new house and it's 8% or 7%? Right now we have a 6% mortgage going down. So he thinks that Home Depot will be a beneficiary of that because people will need to fix their houses up to sell them. Um, and as interest rates go down, perhaps people have more money to spend on home improvements. Okay, let's look at some of the other positions. Look at that, 31% more of the stock of ExxonMobil. So Exxon and a lot of the energy plays are out of favor right now, but they pay a yield. Exxon pays 3% yield. So perhaps he's getting one of the higher reliable dividend stocks. And let's see. All right, so that was a good little exercise. Sometimes I get my best ideas when I look at the top positions of really smart people. But in his talk, he said basically, if the economy does good, stocks are going to do good. If the economy is doing bad, then basically stocks aren't going to be a good investment at that time. So he doesn't see the economy going into a recession. So majority of people on CNBC and prognosticators on the podcast I listen to basically say the economy is doing pretty good. And the Federal Reserve president on Wednesday of this week said the economy is doing good. So all that combined, it seems like we don't have to worry about a recession right away. Okay, so this is one interesting story. Experts cite stocks to buy after the Fed rate cut. So these are the sectors that basically have done the best when the Fed enters a period of gradual rate decreases. Let me see. So Ned Davis says cyclicals have done the best. Cyclicals are stocks that basically are at the mercy of the economy. So if the economy is doing really good, cyclicals do good. If the economy is in a recession or doing bad, then cyclicals go down with it. So it's almost like a perfect track to the economy. And okay, so Jeffries posted a list of stocks that will benefit from rate cuts. They said Google. Why would Google? Because it's more advertising. Um, why would they benefit? Because of rate cuts? Not sure. Shoe company Crocs, JP Morgan, oil producer Marathon Oil, and Owens Corning. So I can see Owens Corning improving as the interest rates go down because you have a higher demand for um, shingles for your roof, and that's one of their major products. Shoe companies, why would they go down? Why would they go up? I can't figure that out. But JP Morgan, as interest rates go down, the banks basically make more money because basically they lend long and they borrow short. So in that difference of lending long and borrowing short is better whenever the interest rates go down. And I don't know why Marathon or Google goes up that more when interest rates go down. Okay, so value and yield would work the best in case of a soft landing, autos, energy, telecoms, and banks. Okay, that's kind of matching our theme for this year of stocks that will be doing good this year. Yield means, okay, so they think high yielding stocks are going to do good in the next coming maybe 6 months to a year. Okay, so all the prognosticators on TV are in a constant lookout for a recession. And there's all kind of canaries in the coal mine. No one knows if there's going to be a recession, but the key determinants of how good the stock market does is if we avoid a recession or not. If we have a recession, stocks usually go down like 15%. And that's kind of what we've been saying. Barron's writer, Paul LaMonica, said Dayforce, IBM, Oracle, Total Energies, and Walmart. The theme for all these, they all pay a high dividend. So these are stocks that, let me see. So Total Energies, they're an energy play, so they have a high dividend. You have Walmart, Walmart does good in a recessionary environment and a growth environment because people trade down to buy things at Walmart if the times are bad. And If the times are good, people spend more money at Walmart. So it's that's why. And then they pay a dividend, and it's going to be hard to find in a year. A 3% dividend that Walmart pays is going to be hard to find in a year if interest rates keep going down. Um, and Oracle, they're an AI play now, and they had a really good earnings report, and they're building out data centers for AI database related products. And IBM, they pay a high dividend, like 3%, and they are growing their consulting and Red Hat related revenues. So um, okay, so that kind of matches the dividend theme. So Morningstar said the following will be doing good. Crown Castle, they are a REIT. Um, so a retailing REIT, reality income. Oh, these all pay high dividends. U.S. Bancorp Energy. Okay, so Morningstar suggests buying these stocks before, right now. These are high yielding stocks. So if you don't have any high yield in your portfolio, it's time probably to start looking. Um, I'm continuing to hold the stocks that I have. They just might not do as well in the next year or so. All right, so I thought it'd be interesting to review the top holdings of Fidelity Contra Fund. Um, and what changes that have been made recently. They're still holding Meta as a top stock at 14.5%. That is a large position. And it grew a lot this year. They're up, what, 50% this year? NVIDIA is the next, then Berkshire Hathaway, Microsoft, Amazon, Eli Lilly, Apple, and Google are their top holdings. That's kind of what my portfolio looks like. And whenever you're putting together a portfolio, you want to try to look at some of the best performing mutual funds. And a lot of times these are stocks that you can buy and hold for a long time and they'll return over 10% a year. And we monitor this list on a regular basis because if a stock comes out of this list, then say for instance, if they got rid of Google, we'd have to seriously start researching why and perhaps look at our position to maybe reduce our position in Google if we have it. But this Google has been in their account for over 15 years. Um, so there's a good indication it's a good long-term hold. And we also see some of the other stocks we're following, such as Visa, JP Morgan, Exxon, and all right. Let's look at the next little article. Okay, here's a AmCap fund portfolio holdings. Let's look at that. I thought this is one of the largest mutual funds in America. So they're holding Microsoft, Broadcom, Amazon, TransDigm Group. Okay, I've never heard of that one. This is an example. If it's the stock you've never heard of shows up in the top 10, it'd be interesting to start looking at that. And there's Capital Group. Okay, that's cash. They're holding a large amount of cash, 3%. Then they have Google, Meta, Apple, Lilly, NVIDIA, MasterCard, Google, Salesforce. Okay, so there's nothing new in the rest of their holdings. All right, that was a good exercise. Maybe we'll research TDG for next time. All right, let's look at, okay, I did a screen for this week. The interesting thing about my screens, okay, what I do for my screens is, I get a list of what, 200 stocks in a screen. I stop at 200 and I sort by market cap first because I'm only interested in stocks that are larger companies. So this is all sorted by market cap right now. And what I do is I sort each of these categories based on, for EPS long-term growth. And the green is basically the top 10 and the yellow is the next 10. So the 10 through 20% tile. Okay, so if we have Google, they're in the 20 percentile for a lot of these. And that's an example of, a decent combination. And what I did was I looked at some of the more interesting ones um, that have a good combination of these green and yellow. So you can see this one right here is amazing. It's PDD Holdings. They're example of an e-commerce platform from China, and I just have a rule where I don't want to get involved in China companies, but they seem to have all the I mean, the best numbers of every one of these categories that we're looking for. And we also have progressive, is one of the better combinations of green and yellow. And Mercado Libre, they're the eBay of South America, I think. And Airbnb is another one that seems to be popping a lot of these. So I thought it'd be interesting to go over two of these. There's one that's kind of a lower, it's like a medium $50 billion company. It's undervalued. It's like supposedly undervalued by 15%. It's Block. They used to be called Square. And I thought it'd be interesting to go over this. And we're gonna go over Airbnb also. And let's go over, let's see. Okay. Okay, let's go over the Square. Okay, Square, you can see that they're growing around 25% if you divide the years, if we divide the earnings for next year by this year, and this year by this year, and this year by this year, we'll get around 25%. So they're growing around 25%. Their PE is 14. So the PEG ratio is 0.56. So it's about half off if you take it at fair value. The one problem with Square or Block is that they have consumer delinquencies. They take some risk with the end consumer. So they're lending money. And if there's a bad economy, and there's consumer defaults, then this company will struggle. And that's probably why they've had these earnings estimates that didn't match. So that whenever it's negative like this, that's an indication they didn't meet their estimates. And a lot of times, if you don't meet your estimates, your stock is punished. And right now, we're kind of in this holding pattern in the stock price. It's basically not going anywhere. So it needs like a catalyst, and that catalyst could be lowering interest rates. As interest rates go down, there are less consumer defaults and customers have more money in their pocket. So that could be the catalyst for this company. So I thought it'd be interesting to look at the numbers. We see one problem with this company that I wouldn't be interested in it because its profit margin is 2.9%. We need at least like a 13 to be the starter value. Same with return on equity. They have 3.5% return on equity. So the big minus problem with this company is they're not very efficient. Um, they need to improve their operations so that they can be more profitable. Um, so their PEG ratio, according to Yahoo Finance, is 0.5. So that's pretty darn good. That means it's half off. And you can see the total cash minus the total debt is 0. So they have no debt. And that's good. So let's look at what CFRA said about Block. They said it's a hold. And it says we regard SQ as a potential industry disruptor with a two-sided ecosystem positioned to drive incremental user engagement. Basically, Block makes the device that you can go to a local cafe and enter your information in an iPad and pay for your meal. So they made it really easy for small businesses to accept credit card transactions. So when they consider enhanced lending risks, Afterpay, Square Loans, and Cash App Borrow. Okay, so they have a very popular Cash App program, and that's a good bonus. But if they say cash out borrow, that means they're taking a risk the customer won't pay their money back. And the integration of these ecosystems eventually could make it difficult to manage that risk. That's why CFRA has it at a hold and not a buy. But they did say that it's overvalued by 2%. So according to CFRA, they're not even undervalued, they're overvalued. And when I looked at their free cash flow, it's negative, negative, little bit, little bit, little bit, little bit, negative. So it's not going up in a straight line like I would want. The revenue is going up in a straight line around 10% a year. That's decent. The problem is their expenses. I don't know what they're spending money on, but they're not very profitable. And their return on equity is negative, 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 5, negative, negative. Okay, so you combine all those things. We just have too many unknowns, and we have a problem where customers default and they're lending money to people in an environment that's the slowing economy. So you put all that together, I'm not interested. I'd rather sit out that one. If if this stock decided to go down in half, I would then look to buy a little bit of it. Here's another story. Another one of the stocks that showed up on our screener was Airbnb. Um, where is that? Right here, Airbnb. There it is right here. So we see it's supposedly undervalued by 5%. It has 58% return on equity, cash flow increase of 136%. Okay, these are all like good indications. We have ROI of 45. That seems pretty good. Let's look at why it's on sale. A lot of these stocks they're in this screener. They all have warts. They all have problems, but you have to determine if those problems are temporary or long term, or will they go away eventually? So let's look at okay. So let's look at what Morningstar said. They said the latest price, the price to fair value is 0.89. That means they're 11% undervalued. Why did they drop recently? They Google says there's a slowing demand. Airbnb reports signs of slowing demand from US customers, particularly for long stays. So Airbnb has made an official bullet point to try to get people to stay long term. There also has been stories on the news where people stay longer than a month and they squat on the house and they can't get them out. So that's another major problem that they have to work out. Um, and Airbnb didn't help these people in these news stories get the squatters out of the house because you have to go to court. And by the time you go to court, the person's still there 4 months from the time they started renting. So that's a major problem why I wouldn't want to rent a house long term. Um, Shorter booking lead times. Airbnb, you see missed estimates. They missed their estimates. You saw those red. You see all these red missed estimates. If you miss estimates, your stock's going to go down most likely. And what other reasons? Macroeconomic concerns. If their economy is slowing, people are not going to be going on vacations. Slowing growth. Airbnb's growth has slowed as the post-pandemic travel surge weakens. Let's look at proof of that. You can see that its growth at 100% for perhaps the post-pandemic time frame, then 28%, 25%, and then 10%. So that matches our Google's AI turned out to be pretty darn smart. All right, so let's look at okay. And so Airbnb management forecasts growth to be continuing the trend down. So their estimates aren't as good. So this is another stock that looks good on our screen, but when it comes down to it, has um, a lot of problems. Um, all right, so they're about fair valued right now. I would start looking at this stock if it dropped in half. Right now, it's just there's too many possible problems. Um, there's too many possible problems, and I think maybe after some of these Google AI mentioned problems are resolved, maybe I might be interested. All right, so let me see. All right, so that's what I had for today. I hope you enjoyed that talk, and let me know if you have any questions, and I'll go over it for next time. All right, well, I'll see you all next time.